Today, we're going to dive into the financial ocean, and we're not hopefully going to just simply float on the surface. We're going to be kind of exploring beneath the waves, the real currents and the market flow, and we're going to distinguish really the difference between the two key concepts today of market conditions and market structure, right? I've asked that question a lot in the past, like, what's the difference? What's the difference? What's the difference? And I want you, the best way to kind of explain the difference of market structure versus market conditions is I want you to picture market conditions more like the weather, okay? It's unpredictable, changing frequency, and sometimes calm, sometimes stormy. And in the trading world, market conditions represent maybe the short-term fluctuations in the market. The day-to-day, the times that you're trading, if you're trading for an hour or 2 hours, even minute-to-minute changes driven by news, sentiment, or economic data releases, things like that can change market conditions very, very rapidly, right? Now, if you using that same analogy, if you picture market structure more as the climate, that doesn't change with as the weather, right? The climate really doesn't change with the weather. It's a broader, more predictable pattern of how a region behaves throughout the year, right? And so in trading, structure refers to those long-term patterns or technical formations in the market that persist over time, regardless of whatever the short-term conditions are. These can be trends, ranges, channels, or various forms of price patterns, right? Now, understanding the interaction between the two, the weather and the climate, or the conditions and the structure, it allows us as traders to navigate the markets more effectively. And it's not just about knowing the forecast of the day, but it's also understanding the climate to make your long-term strategic decisions, right? You're going over your 1, 2, 3s, understanding what structure is, and then coming back to price cycles. So we do that every single day. One, what's the trend? Right? That's more structure, overall trend. And you're looking at the day, the hour, whatever that is. And then you come in all the way back into price cycles. Well, that's conditions. And so that covers the 1, 2, 3. You're looking at that every single day, right? All right. And now I kind of want to throw it out to you guys really quick. Everybody, I want you guys to kind of look at the chart, find a currency pair, find a couple of them that you want to look at, and look at any chart, doesn't matter. And then kind of tell me, what do you think the market structure is? Okay. So what is the market structure for the time? So call out the pair, tell me what the structure is, and tell me, is it trending? Is it ranging? Or is it an outside range? Right? And then I want you to guess the current market condition on that trend. Is it calm, volatile, bullish, bearish? What is the current market condition? Is it forming a pattern? Can you see, is it coming into an M, a wedge, a flag, a pennant, something like that, right? And that's our condition. So let's try and find the structure and then dial it into the condition. And then let's see, and then some of you guys throw that out there, and and then we're going to look at the chart really quick. So we're going to do that. I want you guys to do it. So do it. Anybody? See, throw it out there. Okay. Let's take a look at this really quick. 50, 50, 90 says the EU. Megan asked the question, are conditions associated with the short time frames? Conditions are associated, with what it is now, right? And those conditions change. So you look outside, you just look at the weather. Well, it looks like it's going to storm. Well, or it's raining now, or it's going to storm here in the next hour, right? That's what the conditions are. Do you need an umbrella when you trend, or do you need sunscreen, right? When you trade. So that's what conditions are. What are you currently in for your trading session, right? All right, so we got 50, 50, 90 says the EU on the hour is downtrend overbought. Okay, so let's take a look at that. So we got the overbought for sure on the hour. Now it's coming back in and doing this thing. So we got the downtrend from the overbought, but 50, 50, 90. Then I'm going to ask you the question, like, what is the current conditions, right? So this structure is that it came up, overbought. Now it's coming back down. Now you have to understand, why did it come up? What was the why? Because this why will help you to understand if this was a news event, right? Then you can kind of learn, you can kind of say, okay, is it rounding the corner? We're going to fib it, or is it come back to 50%? That's the structure. Is it going to get a response from being overbought, right? Is it going to pull back? Or if it's not news, which, obviously it's vertical, or is it just a marching market or a drifting market in that direction, which, there was nothing here. There's no real reason as to why. That might not be followed by a strong response, right? And so by understanding that market structure, again, you understand the reason why a move happened, and should you or should you not get a response to that move, right? So let me take a look at a couple of them really quick. Let's see, it's 50, 50, 90. Yes, range bound current conditions. Exactly. So if you come in here and you're looking at we got to go to current conditions here really quick. I have too many waters. Current conditions on the one. Definitely. Okay, so if we're looking at the one, we're definitely in that kind of a range on this, right? So here is kind of your range that it's trying to formulate. However, if it does break this, conditions will change, right? So if it breaks out of this box or this box right here, conditions will change. Now, it could come down. I could have drawn that box a little bit bigger, but you get it, right? So it came down and it kind of pulled back up. It fell to cross this point right here, and we'll see if it falls across this point. If it does, you could get yourself into a nice little ranging market, and conditions. Those are the conditions, right? Okay, so what else we got here? I'm just kind of looking at Duke says the UJ. What does HTF stand for? My brain's not working, Duke.
Higher time frame.
Okay, so higher time frames. Thank you. Like HTF. All right, so we go UJ, higher time frame, boom, boom, boom.
So if you look on the one, it looks like it's down, but if you look like that, it's going up.
Yep. So we got our trend right here, right? Or you definitely have it going up on a market structure, but you also have, what else do you have going on right now for as far as market structure on the 1 hour? Anything else that you can see?
Well, we're basically in an outside range.
And so what does that tell you?
Watching market up.
Yep. An outside range will also tell you that you don't know where it's going to stop, right? You have no idea where it's going to stop. And so you got to pull this out to
price cycle.
You got to pull this out to the day to see where it's going to stop, where it has possible bounces, right? So let's see here. Joseph, it's like I stepped down. I just stepped down is a topping pattern, range mount. Okay. I'm just looking at your guys' comments. Good comments for sure. And then current condition on here is that you see this W forming, right? So if the W forms, then that tells you that it's going to have continuation to the upside. But you could also say that on the 1 minute, it has gone from being an outside range. And so this is a really, really good example of why you need to know structure and conditions. Really, really great example, because we're in an outside range as far as structure goes. So if it breaks, but what we're ranging as far as conditions go, right? So conditions are that we're in a range right now, and it's liking this range, but structure says we're in an outside range. And so what does that tell you? What does that tell you if you were going to be trading this pair right here?
Safer
Duke, since you,
buys.
what's that?
It's safer to be in buying with the market bias.
Yeah, it's safer to be in buys for sure, because this is the direction. However, it also is going to tell you what, like if you are into buys and it does break the top of this, we could see continuation of this.
All right, we should hold and not just take profits early.
Exactly. And so by knowing the structure, you know that, hey, if it breaks the top of this, it could run, right? Yeah. And if you see this chart pattern right here, you could say, okay, it's probably going to come up and test the top, right? And so that's why knowing the structure and conditions is really good, because even though we're ranging, you can be buying and selling inside of this range. But when it comes to the top of this range, you don't want to be selling, right? You want to look for your 1, 2, 3s. You don't want to be buying per se, but you want to play the breaks, because structure says we're in an outside range and it could continue to go up, right? If we were in a downtrend on the structure, then you would definitely be playing the sells when it comes to the top. And that's why structure helps you to identify what direction you should be in overall. And then conditions help you to identify how heavy, what's your position size, where you should be looking, all that kind of stuff, right? And so that was a great, for those of you guys that just offered that up. Let's see if anybody else did any other pair. Christian says the euro and the Audi downtrend. Let's take a look at that. All right. So on the hour, you're saying what on the hour? Downtrend has consolidation in a range on the hour. Okay. We're going to look at the downtrend. Definitely downtrend. So sometimes the trend is, obviously bullish or bearish trends are fairly easy to spot in the market. So we got a definitely downtrend, but it's also coming into an area where it's kind of ranging. So it's definitely been a downtrend, but that downtrend stopped about right here. Right. And so now it's no longer in that downtrend. Now it's in a range.
Sideways.
It's sideways, right? It doesn't mean it might not continue, and you'd have to pull it out to even more, because this downtrend, once it crossed over here, became a downtrend and in an outside range, right? Because it broke out of this range right here. And so you have to be careful, because same thing we just talked about on the UJ, you could get continuation of this, right? You could get a continuation move, but more often than not, it'll go sideways, and you should get a response to this down if you understand why price moved down or in an outside range. And so that would be your understanding of why did it move down. Right? Was it because of a news event here, followed by a 50% pullback, followed by another news event that triggered the start of this rundown? And if these two events were triggered by, this is news that there was a catalyst for that start, then this is your 50% pullback. And then was, again, news with catalyst for this drop out of this range, right? And then the next thing you got to know is, well, now it's ranging. So what's the next catalyst that's going to start the trend up or down? And if there's nothing really in the future that's going to be a catalyst, like during your trading session, then you would play the range. You just play the up down range and come down to the lower time frame. on this chart. And definitely now you're like, okay, are we still in a range? Is the condition a range? And you can say yes and possibly not. This is a difficult one because you could be like, well, yeah, it is, but it's also testing. So here's your kind of your range right here, but it is testing at the moment. And if it breaks, this right here, then this could be a KPI for this being the apex, right? And so you understand this is your KPI, your key price indicator right here, that if it does break down, this could be the apex of the turn and it could come down to here. And then you go back to your larger time frame on the hour and you get your price where you're like, okay, if it breaks here, we'll talk more a little bit about it, but if it breaks here, that's 50% of that range. And if it comes down and breaks that, then it's probably going to come down to the bottom of that. And so you would take this price, whatever that price is right there, and you would probably shift that onto your 1 minute or your lower time frame so that you can identify where that KPI is. And if I was a betting man, I'd probably say that it's probably somewhere in here, right there, where we drew that, right? So in fact, let's take a look at it on the hour. The KPI is right here. What is that? 159,324. And so it's just a little bit below that, but right on that shelf right there. So again, this is where your KPI is. So if it comes down here, breaks this, and it journeys all the way down here and breaks this, then you should be in sells for the journey down to here. If it comes down here, fails to break and bounces off of it, then you should be in buys for the journey back to this point. And that's how you play ranging. And really, I mean, there's only like certain, I think sometimes as traders, we create our own confusion, right? And I'm trying to really just kind of simplify it for you guys and bringing you guys like the 1, 2, 3s, right? There's only 3 really types of market structure, 3 types of market conditions, 3 pieces of evidence. Break it down into the 1, 2, 3s and simplify it as much as possible. What gets you in trouble is when you have bad PTP because you don't understand market conditions. And let's say you're selling when you should have been off this bounce, or that it crosses here and you're selling and it's going to run up on you, right? And then what happens is if you don't have the proper position size, then you risk out and your day is done trading, right? But if you have the proper position size for the conditions that you're in, you could withstand just about any move against you. And the problem is that even with the proper position sizing, you got sometimes as traders, we don't have proper position sizing for the various markets that we're in. Sometimes we're way too light and sometimes we're way too heavy. So by understanding the various market conditions, we get to play with either, I'm just going to use this as an example, but either you're trading with a 0.01 because the price cycles are 15 to 20. But sometimes you play with the 0.01 when the price cycles are 2 to 3. And this is not going to do anything for you. And, or equivalent. You keep the same position size for the same market conditions. And sometimes on the flip side, we're trading with one lot here and we're trading with one lot here. And so we get either heavy. The biggest difference is we're either heavy or we're too light. We're either heavy or we're too light. And that's hard because the hardest part of trading is recognizing when conditions shift, when market conditions shifts. And the easiest indicator to that is really price cycles. And we know that price cycles generally change after consolidation. After you get consolidation and a breakout, price cycles tend to change, or we could come back and say conditions change, right? Conditions start to change. All right. So let's jump back to presentation really quick. Now, again, and as we just move forward into the next couple slides, understanding the difference between market conditions and market structure is really like knowing, how to sell no matter what the weather is, right? And so are we going to use an engine today to propel us, or we're going to be able to use the wind today to propel us forward, right? It's really knowing what we're going to be using during our trading session. Everything is predicated upon knowing what you're going to be doing during your trading session. Now we're talking, 99.9% of us here today, when we trade together, we traded scalp trading. So everything that I'm talking about is going to be predicated towards or positioned towards the scalper, right? All right. And so with that, let's kind of jump into what I consider market structure, market conditions, all that kind of stuff. Okay. So as we really get going and we kind of go through the journey here of this presentation, we're going to explore more of like the landscapes of market structures and how to identify it. Now, remember, we kind of identified, or we're going to use the analogy of the climate and the weather, because I think it's a great illustration or a great point to learn. And so market structure is more like the climate. It's a broader pattern of behavior that persists over time, much like how a desert typically remains hot and dry and the poles remain icy and cold. Irrespectively, that's the daily irrespective of the daily changes in the weather, they're typically cold climates or they're typically hot climates, right? And so now coming back to, how do we navigate that terrain, right? Where we basically need a compass. We need to understand where our compass is, and that's why we have KPIs or key price indicators that kind of act as our compass. How the compass uses, like a magnetic field to guide you north. The KPIs can also use certain price behaviors to help us to understand market structure or where the shifts are in the market, right? And so by understanding your KPIs or your key price indicators, it's like your compass. It's going to help you to navigate when that shift in the change is coming, right? And another essential tool in our belt is the rule of three. And I want to kind of just use this to simplify trading for everybody, right? And, kind of like when you need 3 points of climbing, like if you're climbing and you're on a mountain, you always need 3 points of contact when you're climbing the mountain for stability, right? And we seek out those 3 pieces of evidence every single day. And I talk about it, how you need to be able to get to the point where you need to be able to read and react to the market and identify those 3 pieces of evidence. And a KPI can be one of those pieces if you're right there at that price. And we have to be able to identify it really quick and rapidly and be able to make the decision to ourselves, is it still supporting, is the condition still the same condition that it was now, right? And those conditions can change at a moment's notice. And that's why we bring in those 3 pieces of evidence, right? And so it's not 1, it's not 2, it's 3 pieces of evidence. And this is really just to validate, give the trader, you guys, the confidence to make better or informed trading decisions. Right now, let's jump into a couple things, and let's journey into more of like, what are they, how to identify them, and how do we can use them, the KPIs and the rules inside the different types of market structures and market conditions here. Okay. All right. So in my mind, it's going to dive into the climate. We have three different types of market structures here. So again, back to the climate. As traders, we know that the markets don't just move in one way, right? It's not a monotonous march, but it's more of like a dynamic dance, if you will. It's a dance over the long term that creates distinct patterns, and we call them market structure, right? And so let's take a look at the primary market structure. We have trending, ranging, and outside range markets. Now, first, imagine that the trending markets are kind of like summers and winters, right? And so they're like those long stretches of sunny days or reoccurring snowstorms in the wintertime. They have clear direction, and these market price move. In these markets, the price moves in a distinct direction over time, either upwards, an uptrend, or bullish market, or downwards, downtrend, or bearish market. Right? They form highs and lows, creating a marching channel, a stair-stepping patterns, and we'll explore a little bit of those later. But if you look at that, we're kind of in the summertime now, and so we're going to be getting those long stretches of sunny days, of trending markets, all that kind of stuff, right? And then we have our ranging markets. And so if you picture these type of ranging markets, kind of like our spring and our autumn, kind of what we were just in, the fluctuating temperatures, some sunny days, some rainy, but generally the weather hovers over a consistent average, right? And in a ranging market, prices tend to oscillate between an upper and a lower range, or support and resistance levels, right? And they tend to do that without maybe necessarily a clear trend. And so I think it's very important that we use that analogy in our trading to be like summer and winter tend to have more trending markets. Outside of that, we have more ranging markets, right? And then finally, lastly, we have what we call the outside range. And these are like sudden or unexpected climate shifts that, on usually a hot day in the middle, an unusual hot day in the middle of winter, right? Or a cold day where it's snowing in July. That's definitely an outside range. It's outside of the range. And so in trading, when price moves aggressively outside of a defined range, usually it's due to maybe an unseen event or news or a shift in market sentiment or something like that. That's what causes the outside ranges. And just understanding the climate can also help us plan our activities in trading, right? So we're going to go outside, we're going to go hiking, we're going to stay indoors. Understanding the market structure allows us to create really effective long-term trading strategies, right? Or short-term trading strategies. And really the key lies in recognizing these structures and helping you guys to adapt your trading strategies. And that's the thing that I love to do, is trying to figure out what is your techniques, what are your strategies, what are your go-to, and then fit them inside the box of market structure or market conditions, right? And so if you're trading, if you're going outside you're in a swimsuit, but it's freezing, that's the same thing as trading heavy in a huge price cycle market. You're just not prepared for the conditions that you're in, right? And so that's the whole point that I'm trying, really the whole reason why we need to understand market conditions and market structure, so that we have the right tools or the right clothing or whatever. We're prepared for when we step outside. When we step outside, it's kind of like our trading. When we're getting ready to trade, we got to be prepared for what's going to happen, right? Okay, so now let's kind of dive in. Now we kind of get an overview. Let's kind of dive into more of the intricacies of each market structure, and kind of learning a little bit about that. Okay, so trending markets. And this is where we're going to spend a little bit more time today on trending markets. This is where I put a little bit more time here because this is what we're stepping into, right? The summer markets tend to have more of these type of trending markets, where we're going to see marching markets, drifting markets, channel market, and then maybe even a stair-stepping trend. This is where I'm like, okay, I got into this and I didn't really get the full presentation done. But because I wanted to spend a lot of time on the trending markets. All right. So kind of going back to now, we've kind of identified market structure. We brace for the weather, whatever the weather is. We understand what the climate is. Now we're ready to kind of take our steps outside, whether it's a jacket or swimsuit that we're pulling with us. We're ready to take a step outside. And we're going to talk about the three different distinct landscapes or the trending types of trending markets. Right now, first we have, like I was talking about, the marching market or a drifting market. Picture this as like a calm river that's flowing steadily in one direction. This is where the market is just moving in one direction with very little to no counter trend movement. It's gradual, consistent slope rather than a marching soldier who rarely changes their course. That's why it's called a marching market. It's been said, oh man, I can't remember that quote. I'm just going to look it up. But it's been, back in when a marching army, if somebody can remember this quote, would tend to start its march. It's been said that in a lot, in the olden days when, the Crusades or whatever, just picture the Crusades, it would take literally a couple days to make a turn of the army, because it would take so much to turn that marching army for the communication to actually turn. It would literally take days for them just to make a turn. And that's why we call it a marching market, because it just keeps going and going and going before you get that turn, right? And that's a marching market. Now, what I want you guys to do really quick is, if anybody can go out there and look at the chart, give me an example of what they think is a marching market, and then we'll jump over and take a look at it, right? If they can find a marching market example. I was going to bring in the examples, but I'm like, no, I'm going to let you guys see if you guys can find the examples. So show me an example of a marching market that's out there. And as you guys are looking at that, I'm going to talk about a channel market. Okay. Next, it basically, if the marching market was a calm river, then think of the channel market more like a winding road, right? That you're traveling down. It's broader. It has more sturdy fences. These fences act as our support and resistance levels. And as the market just kind of meanders, if you will, it flows up to the resistance, flows down to support. And if it crosses the midpoint, or the 50% of the channel, is likely to make its way back to the other end of the channel, like a pinball kind of bouncing between two bumpers, right? That's what you kind of consider as a channel market. Now, let's take a look at the marching market. Now, when we're looking at the marching market, somebody find me a channel market. So Bob says we were in a marching market on the 15th, Euro USD. Okay, let's take a look at this. So this is definitely where you consider a marching market, right? Where you got price that barely comes back and does a pullback. So you got this all the way up to here would be a marching market, right? And this move right here is a 57 pip move. So you have from the bottom to the top is a 57 pip move, and you get one pullback of 4 pips. That is definitely a marching market, and that is definitely what you're going to see coming into the summertime, where it's just like a river that just continues to flow. And then would be a bend in that river, and then you have the continuation, right? So again, using that river analogy, rivers are not going to come back and flow the opposite direction, right? And so that's where the marching market comes into place. And this is the things that will destroy you if you are not ready for these conditions. Now, you could say that this might be one too, but this is more choppy, and depending on what those things are, it could be a marching market, but this is particularly a classic marching market right here. And you could say it even started here, but this is a great example of a marching market for sure, right? Where it just goes in one direction, rarely gives you a pullback to get out, and it tricks you thinking that, oh, okay, here's the turn. Now it's going to turn. It's going to come back at least 50%, which will put it right there. It's going to come back at least 50% of this move. And then, nope, it doesn't. Does not come back 50%. That's a typical marching market. It will not come back. It will not come back 50%. It will just continue to move up, right? And so, great example. Thank you, Bob. Okay. Anybody have any examples of a channel? Anybody have any different of a channel market? Examples of a channel market. Let's take a look at that really quick.
I think this is one right here.
Where?
The chart you're looking at. It has. Yes, no.
From what price?
From the middle to almost the end, there's a diagonal channel.
But if this is a marching market right here, then what's the difference between a marching market and a channel market?
Kind of the same. Channel means a diagonal range. Yeah, bingo. Okay, there you go. The blue, I guess.
So the biggest difference between a channel market and a marching market, and I think you're saying the same thing, I'm just going to define it a little bit better, is that you have price that you can actually make money with.
Okay.
On up and down, right? Between up and down.
Okay.
Right? Here, you can't, if you are into sells in a marching market, good luck making money on sells. Does that make sense? So that's that's really the difference between a marching market. The difference between a marching market and a channel market is really the difference between a marching market and a channel market is basically you can make money on the up and down movement inside of a channel.
Yeah. In fact, the reason it's called a channel is because it meanders like a river within its channel between two levees. Like the two blue lines are like two levees.
Right. And so that's why I'm like, as long as we have enough pippage to make money, then I would call that a channel. So I'm going to just do a quick measurement really quick. So it comes up here, comes down to there. There's 3. So then it comes up to the top. There's 9. Comes down to the bottom 7. So yeah, this could be a channel where you're coming up to the top and the bottom for sure. But this is probably a tough channel because there's not a whole lot, 2 to 4 pips. So if you're scalping that, yeah. So let's see if we can find a better channel.
If you look at the pound, Frank, the 5-minute charts, it's now in a channel.
It's now in a channel. The pound.
Yeah, pound Frank, the 5-minute.
All right. So you're saying this is the channel right here?
Yeah. Don't end up wide.
All right. Let's take a look. You got this right here, 9 up, kind of hard. Come down, 5. Okay, so yeah, this is a channel, right? So same with the other one. The other one was a channel too, but when I like to look at channels, when I like to trade channels, I tend to like to look for wider channels personally. Like these things would be so on a larger time frame, not necessarily on a 1 minute, but on a larger time frame, I'm hunting like on a 5-minute. I like these to be more like 8 to 10. If the ones I like to trade. Then what you do with the channel is this is your support and your resistance, and then this is your 50%, right? Yeah. And that's how you trade the channel.
I'll just show you the concept.
Yeah. Oh, let's see here. Christian. Yep, that's a good one. That's a good one for sure. Right. So you got what you're showing me. This is Christian's, what he's shared. That's a good channel right there. So that's what I would consider as a channel versus a margin market. I love trading channels more than I like trading margin markets. I think a lot of people will say that. Because margin markets, you just don't know when they're going to stop. You don't know when they're going to start. And you can start to identify, they're a little bit tougher to identify when to get in, when to get out, and all that kind of stuff, right? And Joseph is exactly right. Margin markets always stop 2 pips after your risk out. Love that. Okay, let's jump back to kind of the rules, if you will, of each one of these, because this is we are going to see more of these, right? We are going to see a lot more of these types of markets, right? And then lastly, if somebody can show me an example of a stair stepping market or a stair stepping trending market, let's hunt for an example of that, right? And if you look at like a stair stepping market, it's, obviously that's name is because if you imagine like a staircase representing a new high or a new low, depending on which direction it's going, with periods of consolidation between the trends that kind of resemble those landings or the stairs, right? And prices will climb or descend, but they tend to rest on consolidations forming like the flat step before resuming their journey, right? So let's see if we can find an example of a stair stepping trend, right? Anybody want to call one out? Let's go hunt for a stair stepper.
But
Go ahead.
the Euro USD M15.
The Euro USD on a 15.
Yep, right on present time.
This is what I'm seeing on the 15. So the Euro USD 15, where do you see a stair stepper?
Yours look well. I moved it to here, so this doesn't influence it so much. Maybe that was it.
So if you're
You've got the down, not that far, but about there. Down, up, and it's just going down.
okay, so you had a little tunnel, because if you look at it like that, then I'm like, I don't see
Right, it looks more like a ranging market.
right?
Yeah.
And that's why sometimes get tunnel vision.
Mm-hmm.
So this is exactly what we're looking for as a stair stepper. That's the pattern we're looking for.
Yeah. Okay.
Right. So who else says the daily has a stair step a few weeks back? Let's take a look here. Yeah, you could say on the daily for sure, right? Where it comes down, goes sideways, comes down, goes sideways, comes down, goes sideways, comes down, goes sideways, and then comes back up. Generally, in a stair stepper market, you tend to get the 1, 2, 3s, right? Usually, you get those patterns in the 3, right? And so let's see here if you have one coming up. Kind of do a little bit, but not. It's harder to see, right? Or it goes up sideways, but then it goes back down, but it goes up sideways. So,
okay.
Well, let's see here. Christian pulls us in to another screenshot. Let's see. I love the screenshots, guys, because then I don't have to hunt. Yeah, this is a good one where it goes up, consolidates, goes up, consolidates, goes up, right? And this is a stair stepping market. And you usually get this in 1, 2, 3s right there. See, Martin shares a screenshot of one of I'm assuming this is a down. Where you got here's your first step, your second step, it goes down. And this is kind of hard because you're like, okay, is it still stair stepping if it crosses this and goes up to this point, right? Well, if you widened it out on a larger time frame, because he's on the M1, I would probably say that yes, right? Because they would probably look like that. And so you need to look at your larger time frames just as much as you look at your 1 minute, or because if this is like a 15, then you probably wouldn't see that. This would be more of a marching market on the 15, right? Okay. Hilarion, we're going to talk about that in the next slide really quick. So if I don't hit your question specifically, then come back and point that out, because I will open it up for questions and answers here in a second. Okay. So good job. So those are kind of your examples of your marching market, your or your trending, different types of trending markets, right? So the different types of trending markets that we have are, the marching markets, the channel, and the stair stepping. These are all the type of markets that we will see in the summertime, and in the wintertime, you see more prevalent and showcasing itself more often. Okay, so what are the, when it comes to marching markets, what are some of the KPIs or the rules of a marching market, right? And so what are some of these essentials, or recognizing these signs, when it basically, like we talk about the KPIs or key price indicators, and let's also kind of apply the rule of 3 here to marching markets, right? And so if we're looking for a marching market, or how to identify a marching market or the behavior of the marching market, we're going to, I'm just going to mute you guys really quick. So if you guys want to talk, you can unmute yourself. All right. In the marching market, you'll observe like a 0 to very, very, very small price movement counter to the trend, right? So we've identified that our marching market will just continue to go up and maybe not counter trend, right? As if the market has picked a direction and it's just sticking to it with only minor deviations. You won't see many significant pullbacks or reversals. And our second KPI is basically the absence or low prevalence of price cycles. Instead of peaks and troughs, you'll see cycle patterns. You'll see consistent and prolonged movements in just one direction. And third is look for lower volume in the market. Lack of volume can often indicate that there are fewer transactions that will most likely oppose the trend, meaning fewer participants. The fewer the participants in the market, the better odds are that it's going to be a march. So when we look at a day like today, where it's a holiday, no news, very little traders, it's conditions that are ripe for a marching market, right? And so if you understand that when you're coming into your trading session, you're like, okay. And in the summertime, when you have volume is lower, and you combine that with a day where your trading session has no major news events, what's going to pull the players into the market if there's no news events, right? Well, if there's nothing, then that has the propensity to be a marching market day, or the doldrums of summer, where it just moves very, very slow and one direction. Okay. And so just to recap, a marching market, how to identify a marching market is it's a little counter movement, minimal price cycles, lower volume, and those would be your 3 kind of KPIs, if you will, to identify that a marching market is about to occur, or be on the lookout for a marching market during your trading session. And remember, just like we're talking about, always have at least 3 pieces of evidence supporting anything that you're thinking about before concluding that, yes, you are indeed a marching market. Look for 3 pieces of evidence before you start trading it as if it's a marching market. Because the other side of that coin is, if it's not a marching market and it's an overextension of a direction, it could pull back pretty hard. And so you don't want to build into a marching market unless these 3 things are prevalent in that condition, right? And looking for those conditions. Right. All right. Then Okay, now let's talk about the rules. Here's the marching market rules. Now, being able to quickly and to identify the marching markets, now it's time to understand how we can operate within one. So here's the 3 key rules that you need to follow when you're trading inside of a marching market. The first rule is to remember is to build into that move, do not counter it, right? That's the obvious one. You don't want to counter trend trade into a marching market. Think of it this way: you wouldn't attempt to march against the direction of the parade, would you? Right? So if a parade was coming at you, you wouldn't be going in the opposite direction. You would turn and you would go in the same way as a marching market moves steadily in just one direction. Right? We don't want to align. We want to align ourselves with that flow, gradually increasing our positions as the trend continues. You're not going to get a pullback, but you definitely will get a stall. And if you get a stall that fails to come back 50% of the previous candle, that is a good place to build in to that marching market. Okay. The second rule is that we need to start to look for the apexes. Right? And when the market is indeed overextended, you're starting to look for your exits. The apex represents the peak of that trend, and usually will align to a larger time frame support and resistance. So when the market is definitely stretched and it's likely due for a pullback or a reversal point, it's basically at a larger time frame where you hit major support and resistance areas, right? And spotting these movements will allow us to get out, to time our exits sufficiently, lock in our profits. We do secured trades in case it just ignores those action points and continues to go. And we do not want to start fading until we get confirmation that that is the case, right? Or it's not going to have continuation. Because just like we talked about, marching markets will ignore price points, will ignore those support and resistance areas and just kind of go. But major ones is what we're looking for on larger time frames, okay? And then lastly, the third rule of a marching market is to stay light, but take larger pips, right? Simply meaning that we keep our positions relatively small, giving the market room to breathe while aiming for larger profit targets, right? It's kind of like making sure that we're trading with smaller position size, going for 10 to 20 pip gains, right? And we want to ensure that we give ourselves enough space for the market to maneuver. And if it does pull back a little bit, we can get in and fade in, like that example where the marching markets where it went up 50, pulled back 4 in the entire move. We had a total move of 50, and there's only one pullback of 4. Classic marching market on that example, right? Basically, to sum up everything in a marching market, we want to align ourselves up with the move. We want to be on the right side of that move. We want to be able to identify the apex for our strategic exits, and we want to stay nimble enough in our profit or our position size to be able to aim for bigger targets. By adhering to these 3 rules, we can position ourselves more effectively to trade within marching markets. Again, wanted to put a lot of emphasis on the trend of the markets because that's what we're going to see in the next coming up in the next couple months. We're going to, as we started to already see them last week. All right, next. And this is basically as far as I've gotten. I have it all written out. I just didn't put it in slide format. So we're going to talk a little bit about it, and I'll start drawing it on the chart. But next, we want to identify how to identify the trending market channel. So we're going to start to shift our focus here a little bit from a marching market to the channel market, right? So kind of like what Doug was saying a little bit earlier, that it's, you picture a river that's kind of flowing between 2 banks, right? The river's flowing between 2 banks, and that's kind of like your channel, right? The water or our price moves within these 2 confines, the trend lines or the support and resistance of the channel, right? So this is our channel right here. The first key price indicator to identify a trending channel market is the establishment of the tops and bottoms in the channel. So let's see here. Somebody right here. This is a good example. Great example. So thank you for sharing that, Christian. In a channel market, this acts as our support and resistance area, right? So support or resistance, depending on the direction. Tops and bottoms, and then our 50% line right down the middle acts as our 50% line. Okay. So this is our first identifier of a channel. This is our first identifier of a channel, is that it's touching this point, it's touching this point, coming up, touching this point, right? The second thing you'll notice is that if price crosses the 50% line, which I'm going to just draw a better one here real quick. If price crosses this 50% line, what is it most likely going to do? And this is a great example of that. So if price crosses that 50% line, go back down here, it's most likely going to come down and touch the bottom of the channel or the top of the channel, right? So, and that's your second kind of your KPI, if you will, that once price comes up, crosses this line, it moved up here, right? Came back down, crossed this line, it comes down to here. Moves up, crosses this line, moves up to here. Comes down, crosses that line. This one failed that same pattern, but you can also see that it failed to touch this line, came back down, crossed that line, and touched that, right? As soon as it touches that, come back up, crosses that. So generally speaking, as soon as it crosses that 50%, it's going to come back up and touch the bottom or the top or whatever, right? And so that's how you kind of look for a channel, right? It's going to go to the other side of the channel. Exactly. Yeah. Thanks, Joseph. Appreciate that. So basically, basically on a channel market, and finally, the telltale sign of a trending channel is that the pattern of higher highs and lower lows in an uptrend or lower highs and lower lows in a downtrend. And we talk about that a lot, right? And so you have the higher lows or, the lower highs and the higher lows, right? And so you start to get these in a downtrend. And we look at those all the time, right? So lower lows, thank you. Lower lows and lower highs. So that's what we get in a channel, okay? That's kind of like the three things that we're looking for. How do you ensure you're in a channel in real time? You start looking for those, right? And so if you're in it, you start looking for these, higher lows and lower lows. So when it comes down, if it comes down and you start hunting for, yeah, exactly. Thanks, Duke. Exactly. Like prices, like if it's going to come up in the channel, then it's not going, then this price right here will not cross this area. This price right here will not cross this area. So it's going to come up and it won't cross this and it won't cross that. And that's how you kind of know you're in a channel, right? Now, where you need to also identify, as on the larger time frames, is this a bounce point? Is this the apex? Is this the apex? You got to widen that channel out or you got to widen the time frame out back to market structure. Again, this is conditions. Condition says we're in a channel. Market structure says if you're in a range, then this is the bottom end of that range, right? Or if you're in a trend, this is where the trend is. So you got to find that where market structure is, okay? Yeah, Joseph, yeah, exactly. You only need 4 touches to establish a channel. Great point. Okay, so let's talk about the rules really quick. The trending channel market rules. Now that we've can identify what a trending channel market looks like, what are our 3 rules? Okay. Obviously, the first one is that we want to, more likely it's going to be easier to trade in the direction of the trend. Okay. So if we have a down channel, it's going to be easier to make money on sells, depending on the channel. But usually you want to trade in the direction of the trend and look for the sells if it's a downtrend. Okay. It's the rule number 1 is that you want to trade in the direction of the trend. Like the river current, it's really easier to swim with the tide than against it. So you buy at the bottom of the channel in an uptrend, sell at the top of the channel in a downtrend. Okay. Second rule is that we use that midline that we just talked about, the 50%, as trigger points for trades. If price crosses that midline, is a strong signal of a potential move to the other end of the channel, like the river is currently picking up speed. And then the third rule is always use always kind of use an exit or a stop loss, if you will, to get if the channel shifts in your direction or against you. So if it changes direction, this is where you should exit your trades or look for a shift in the market conditions. So as price, if it's a downtrend, and then all of a sudden this is price hitting this range right here, and then all of a sudden it does this, this is your KPI to where you need to get out of sells. So that's your exit for either a loss or, depending on the conditions, you can need to start fixing your trades and looking to shift into the direction. So the third rule is that when channel breaks, when this channel breaks against you, and this is the apex, and you didn't recognize that this was the apex and you didn't exit here, then you definitely need to exit here on your KPI, right? If you don't, you could be in for a big risk out situation, depending on your position size and how heavy you are, because you didn't recognize that the market has just shifted up, right? And it could be a trend, it could be a response, it could be a marching market, could be all different things. But the moment that it crosses this point where that trend is no longer valid, this is your exit for either a loss or to fix your direction. And that's kind of the third thing that you're looking for, is when that channel is no longer prevalent in the market, you need to get out if you're in the wrong direction, because oftentimes it will go the other direction for a while, right? Particularly in channel markets, it'll go down and then it'll follow back with a channel in the opposite direction. Right? You're not going to get a channel, a sideways movement, and then another channel. You may, but typically you get a channel that's a response to this channel, especially if it's a channel that is companioned with an outside range in structure. So if you have an outside range that's your market structure and you're in a channel in an outside range market structure, it'll generally be followed by a response to that. Okay. And so that's why you need to know these 3 things, right? What is our market structure that we're in? What are the conditions that we're in? Is it likely to continue in this direction, or is it likely to bounce off of this and reverse on me? And again, every time we trade, we only trade in the world of probabilities, not absolutes, in the world of probabilities. And so understanding all of this market structure and conditions helps us to increase our chances of probabilities, to give us a better opportunity to make the most out of our trading session, really. Okay. So, and then basically just a quick recap and summary, you look for support and resistance lines that and the 50% cross. You go look for consistent highs and lows, and remember the rule of three, right? Corroborate these KPIs with additional evidence before concluding that you are in that you're in a trending channel market, right? All right. Now let's jump over to identify a stair-stepping trend. Okay. So let's see if somebody gave me a stair stepper. Yep, right here. Okay, so stair stepper. Again, going back to stair stepping, price goes up, sideways, up, sideways, up, sideways, right? That's a stair stepping in a uptrend. Okay, so the thing is the identifying a stair stepping trend is a series, of higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend, right? And these are often, punctuated with periods of price consolidation or sideways movements called, let's call them our landings, areas that we're going to land, right? So how do you know that this is a stair-stepping market and not just a move up, consolidate, and then move down, right? That's the tricky part. How do you know that you're going to get a move higher, followed by a sideways, and then another move higher, right? Versus what in a traditional ranging market, it'll probably come up sideways, come back down, and up like this, right? And so I think this is half the battle, is that if you know you're in a stair-stepping trend, then you play the stair-stepping trend. If you know you're in a ranging market, then you would play the pullback off of that. And that's just knowing the type of market structure that you're in helps you to identify the type of play that you're going to be using, or the tools that you'll use to recognize market behavior, right? So the first thing to identify is basically, or the first thing to identify is just this if it does this once, right? So if it does this once, where it goes up, sideways, moves up, then pretty much it's going to do it again. And you can pretty much bank on it on the third, right? But if you're selling here and it moves up against you, then you need to recognize in the next consolidation phase that you need to get out of your sells and look for the trend to happen. If you're stubborn and you continue with your sells, that's when I see people sell here and then take the loss here, because they don't recognize that they're in a stair-stepping trend. This is going to be, again, more prevalent in the summertime when you have lack of news, lack of volume, lack of traders, creates a higher propensity for a trending market. That's why I wanted to spend a lot of time today talking to you guys about the trends, because we will and be trading through these in the next coming days. Okay. So we talked about how to identify the consolidation phase, and then third, watch for breakouts of the consolidation phase, and usually it'll break out in the direction of the trend, right? Okay. So how do we navigate these? What are our rules for a stair-stepping market? So once we've identified that we are in a stair-stepping market, how do we navigate it? Well, after spotting the trend, trade its direction, right? After recognizing it, stay in that direction. So we want to buy on this particular one, okay? And then look for buying opportunities following the breakout from consolidation phase. So if you get this, then it breaks out, then you'll look for buying opportunities, like you buy in here, buy in here, buy in here, buy in here, looking for this next breakout to happen. Okay. Rule 2 is you also want to have kind of where your KPIs, you look at where it's going to not happen. So if you kind of put your shifts your KPI right here off of this one. Right here is your KPI here off of that one. And then right here would be your KPI off of this one. So if you got into buys right here, and it didn't break, and it just failed to break, and it comes down to here and it crosses this, well, it's a lot easier to fix your buys here than if you were to buy at the top of this. So having good PTP, proper trade placement, is paramount when you're dealing with stair steppers, because if it fails to continue the next stair stepping, you want to make sure that you're positioned correctly to get out of your buys if it does in fact run against you, for the least, or mitigate that damage against you, right? All right. So then the last rule, so that's how you protect yourself. And then the last rule of a stair stepper is where to take profit, right? So you want to take profit near the previous high in an uptrend or the previous low in the downtrend. You know, these areas are often like support and resistance. And then if you look over here, you can identify, generally you'll have action points over here on your consolidation. And if it comes up to the action point, you can take your profit and get back in, right? Generally, you'll have action points. So if you widen this out, and I'm assuming by these lines, these probably were action points, but you'll have those action points. Where the action points say, get in, get out, or hold, right? So that's kind of the third rule is you want to exit at the action points on these and then get back in. All right. So kind of by following these rules in the stair stepping, really, we can start to identify the marching markets, the channel, the marching market trend, the channel trends, and then the stair stepping trends. These are the three types of trends that the market structure during the season of summer we're going to see a lot of. And so these are the ones that we want to start to learn how to navigate, learn how to kind of coast through, or sell through using our ocean analogy. How do we navigate these? By learning how to navigate the markets of the trends, we're going to be able to pull profit, a lot of profit out of the market. And that's the best and worst part about summertime trading, is that yes, you can get 30, 40, 50 pip runs, even 100 pip runs, but if you're on the wrong side of that and you're counter trend trading, it's probably not going to be conducive. Same thing with the fall and the springtime. If you are trading the trend and not counter trend trading, then you're probably going to struggle with pullbacks and lose your profits, because if you're trading the trend and you're in a ranging market. And so basically it all comes down to market structure, market conditions, what kind of outfit am I wearing, or what kind of tools do I need to navigate the market structure and the market conditions that I'm currently in, right? And again, I just wanted to really just navigate the trend, because that's what we're going to be seeing. Okay, so now let's kind of open it up to the question and answers and talk about what we're seeing, what kind of questions and answers that you guys have. I'm going to come in here, really come back here. I know we can go on, but I didn't want to. I want to save the ranging markets, outside range, all that kind of stuff for maybe another presentation, but really just dive really into the type of trends, how to navigate the trends and your rule sets against the trends. So Hilaire asked Dave, how quickly are you able to tell when a margin market is changing or has changed? Is it easier to see the change on the chart after it's happened, or is it to see it as it's happening? Of course, a sign that the losses are getting bigger, I suppose. That's how I get tunnel vision, because I don't want to believe it has changed. That is a great point. And that's what happens to a lot of us, is like, we don't want to believe. We are influenced by our trades, right? So our bias is our trades. So whatever direction that we're trading is kind of our bias. It is. It's our personal bias. We want the market to move in that direction. We want the market to move in the direction in our favor. And so that's our personal bias, right? And so when we're in a marching market, trending market, channel market, and it's going against us, we really want the market to go in our favor. And so that becomes our bias. And so sometimes it makes us slower. It definitely makes it slower for us to shift our bias. That's why KPIs are so important. So going back to your question, Larry, and how quickly are you able to tell when a market is changing or has changed? If we go back to Friday's trading, let's go back to that because I identified it, but yet I didn't. I wasn't able to shift, and I felt like, well, we'll talk about it. So on Friday, which was right here, zoom in a little bit. Right here on the 5-minute chart, and we'll go to the 1 minute, I think. Actually, better. There you go. Okay, it was right here. I think it was this right here. Yeah, 50 pips, 50 pip run. Right here, we identified that we are no longer in a ranging market. Let me draw that this, if it crossed this was our KPI. So this was our KPI right here, that if it crossed this, then we're no longer in a ranging market and we're in a trending market. And we're not necessarily in a trending market, but it's an outside range market. And we identified it correctly. We identified it before when we were up here trading, and then it came down. And this happens oftentimes. It happens, and it happened to me, right? Where I didn't anticipate it to happen so fast within, 1, 2, 3 bars and then break down. I thought it would kind of bounce off of this, give me a chance to get out and play and revert and change my direction. It didn't, and that happens to us a lot where it just happens really quickly. But that doesn't mean that if it crosses this, that you shouldn't shift your positions. And whenever you take losses in a market, it's always because the market did something that you weren't prepared for it to do, right? And so case in point, on Friday, in front of everybody, we took a loss right here because it ran down 50 pips in a manner of, relatively short as to what it was doing. It ran down 50 pips in 13 minutes, right? Market typically doesn't do that. It doesn't run 50 pips in 13 minutes after a breakout. Now we're going to see that in the summertime. Going back to the summertime, it might happen more often, but this is where you kind of tend to take your losses. And I was caught on the wrong side of that. Now, how to trade out of that would have been just exactly what I was trying to do, which was wait for the first pullback of this, wait for the first pullback and then get out, right? What happened on Friday to me was that it hit my own setting, but it was a new thing for me. So I was still trying to trade the bot, all that kind of stuff, where it just took me out of all my trades. And so I'm like, oh, great. Now I got to take 2 hours to fix them, right? Versus just waiting for the pullback to fix all of my trades. And that's what I was doing, was just waiting for that pullback. So that's the right play. That as soon as you recognize that you're in a marching market or a trending market, the conditions have changed. You need to get out. And if you get caught in a current that's just pulling you further and further away from your trades, you wait until you get that pullback and then you get out, right? And that's kind of the typical rule, right? And that is the typical rule: is you wait for the pullback. On the first pullback, then you get out. I generally will get out on that first pullback. So the first pullback here would have been right here, and that's what I would have rather have exited, but I lost all my trades there last Friday. That was a great example of it. Didn't get an opportunity to do that, to get that pullback. All right. But by But going back to your answer, Hilarion, I already predetermined your KPIs, and knowing where that is will help you to not have tunnel vision. Will help you to not have tunnel vision because you called it before you even started getting into trades. And when you're correct, and you're like, oh yeah, I'm right. This is where I want to shift. This is where my bias should shift. This is where my trading should shift. Right? Is all in those KPIs. All right, let's see if you guys have any other questions, comments. Just scrolling down. Steve says, how do you ensure you're in a channel in real time? You don't see the channel often until it has formed several points. You're right. I'll usually will identify a channel on a larger time frame, right? So if I can identify the channel on the larger time frame, that helps me to see it on the smaller, or be able to play it, not see it, but play it on the smaller time frame, right? So usually we'll go out. That's why I always have the 1 and the 5. I'm always looking constantly looking at the 1 and the 5.
But wouldn't that be from the beginning, Dave, when you come in to see if you're in trending, channel, or ranging?
Yep. And then when you're trading and all of a sudden it turns into that, you go back to your KPIs as where it could turn into that channel or stay in the channel that is on the larger time frame, right? And so, but that does go back to your initial analysis. But every time you get that reset to 0, you should always be reanalyzing the market. What are we looking at? What are we seeing here? Now, if it's a newly forming channel, you're not going to be able to see that. You're not going to be able to see that, but you can identify, are we in a range? Are we in a trending market? Are we in an outside range, right? And by identifying if you're in a ranging market, then, a ranging market, then the channel, if it's a big range, then that channel is probably going to take you to the top of that range. Or the channel is going to take you to the bottom of that range. But getting into buys, because it crossed that 50% of the range, it doesn't really matter if this is a channel market to the top or a vertical move up or just a slow meandering up and down ranging market to the top of this range. Doesn't matter because you should be in buys going to the top of that range. Right. And so if you're in buys going to the top of the range, it doesn't matter how it gets there, it just matters that it does. Right. And when you can say, I'm often right on where it's going, but wrong on how it gets there, then it doesn't matter how it gets there as long as you're in the right direction. And that's what coming back to market structure, market conditions helps you to get into the right direction of the market. Hopefully that makes sense. All right, let's go look at some other questions that you guys might have. Okay, Bro Rabbit asks, if it's a fake out and returns to the channel, do you expect it to break to the other side? Not unless it crosses the 50% of the channel. And a lot of times you will get that fake out. Like if you're in a channel market, the market will go like this, and then all of a sudden it goes like this, and it comes back into that channel, or like this, and it comes back into that channel, right? That's why you need to have your KPIs that say, if it's truly going to break this channel, it needs to cross this point, right? And if it crosses that point, this is my KPI, where if it crosses here, then this channel is dead. This channel is dead to me, and I don't want, and I'm not going to look for that to play anymore, right? Same thing up here is that if it crosses if it goes more vertical, and this is your KPI right here, and then it goes sideways, the channel is dead, right? No longer playing that channel anymore. Okay, let's see here. Absolutely, Joseph asked, would you want to do candle counting for time cycle navigation? Sure. Absolutely. I always do that for time cycles and see when it's going, how long and how often it's going to be running to the point from point A to point B. Absolutely. I always do that. Like time cycles is great. Vegan says, I've learned that usually the first pullback happens quick, sometimes trampoline moves, so I cannot hesitate. I have to be ready for it. That is a great assessment and also a great comment. Sometimes the first pullback of the retracement happens really quick. So that's why I talk about with all my hot seat traders, know what the next 1 to 2 moves are and be ready to execute on that. If you miss it, if you fail to execute, right? The whole saying, if you fail to plan, you plan to fail. So if you don't have a plan on how you're going to execute, then you're going to miss the opportunity. Again, that's why I love so much about being able to secure your trades or placing your stops once you're in profit or a take profit, if you will, because that just helps you execute when that move happens a little bit quicker, right? Okay. Any other questions? Any other questions or comments, anything like that? Basically, I mean, it all comes down to learning your 1, 2, 3s, your market structure, and your KPIs, right? Trading is, if you break trading down to its simplest form, it really does come down to the 1, 2, 3s and the 50s, right? And then you have to make the decision, is the 1, 2, 3s in a range? Is the 1 through 3s in a trend? Are my 1, 2, 3s in a outside range? And then learning the type of tools that you're going to trade in a range, right? So if you're in a ranging market, we're not looking for 1, 2, 3s of a, the 1, 2, 3s are the 3 pieces of evidence, and we're not looking for higher highs or lower lows. We're looking for the 1, 2, 3s of a range that we've been learning about since like February, where it's the price touches 0, price touches 1. It's the first attempt, second attempt, and third attempt. That's how you trade a range. And you're going to break out of that range anytime price touches the top, 1, 2, 3, or the bottom, 1, 2, 3, right? That's your range. That's the rule set that you play in the range. In a trending market, you're not doing this. In a trending market, you're looking for the trend, right? Is it a bull or a bear trend? Then you're looking for, is this a channel trend? Is it a marching market trend? Is it a drifting market, marching market? Or is it a, what type of trend will determine what your 1, 2, 3s are, right? And helping to determine that, finding your evidence of your 1, 2, 3s help you determine where the 50% of the channel is, and where you can either recycle, and we start bringing in all these type of tools that we've learned throughout the many months. Like, it's time to recycle, it's time to hold on, it's time to get into a ride the wave, right? Now the ride the wave is over on your trend. And then an outside range, definitely, what type of ride the wave is it on an outside range? Is it an ankle slapper? Is it a shoulder high? Or is it an Azari wave, right? And how are we using the 1 minute for our exits? We're using the 5 minute for our exits. And where is it? And where is the next possible KPI, right? So you bring in your KPI or key price indicators in all of these. When is the market likely to shift out of a range into a trend and into an outside range? And you identify these 3 things over and over and over before you even start trading. And then back when you get all your trades off, you do it again, and you do it again, and you do it again, and you do it again. And once you can identify this, once you start to see it, you can start to read and react to the market conditions. And as the conditions change, you start to bring in new pieces of evidence to support your theory and thinking, this is when and where the market is most likely to change. Yes, it did change. And now, instead of sunny skies, we have rain. And so we should be trading as if it is raining, not trading as if we have sunny skies. And if you cannot figure out what type of condition that you're in, then maybe you shouldn't be trading that market in a live account. Create a simulated account and do your best guess as to what kind of conditions they are, and then learn from that, right? And then you'll be able to start identifying more and more condition types and bringing in more and more tools to help you during those conditions. All right. Anything else before we kind of end? Because I don't want to open up a whole other thing. I want to keep it cognizant. I want to keep cognizant of the time. All right, guys. Yeah, sorry my presentation was a little bit lacking. I didn't have a whole ton of time with it being Father's Day to really put the presentation out there. But hopefully what you guys got, it was good enough.
Thank you.
So Dave says this is done on an automation, so it'd be a couple hours before it's up, and it'll be in the hot seat training. So, but yeah. So basically, it really boils down to learning the 1, 2, 3s, the ABCs, and the KPIs. You learn all those 3 things, you can trade any market, anytime, anywhere, and be able to say to yourself, I can make 1% any market, any condition, at any time. And that's what it comes down to, is being able to have the confidence that you can do that anytime, anywhere, any condition. And learning exactly what we just went over, embedding that and integrating that into your trading skill set will undoubtedly make you a better trader and be prepared for anything that comes your way. So hopefully you guys enjoy that. And I think with that, we'll go ahead and end there and then look for normal trading tomorrow. Be careful today as the banks are off. So it'll do whatever it wants to do when it does what it does. So be careful trading, and then we'll see you guys tomorrow. So thanks, guys.